Hello everybody and welcome to our discussion of the static budget versus the flexible budget. Here we are talking about how to develop a budget that allows for more reasonable comparisons with the actual results. So we know from previous videos why companies need to have budgets. The idea here is that they set a budget ahead of time, and then as the actual activity comes through, they can compare those actual results against the budget. And this will allow them to determine, do they need to make any changes to the operations if they can't stay under budget? Do they need to change the budget? Maybe it's wrong, it's unreasonable. Maybe the activities or the environment or the economy has changed all of a sudden. And another benefit of a budget is you can determine who should be rewarded for their hard work. You can use the budget to understand and better predict what to expect in the future. So those are some main reasons for the budget. Now the thing that's important to understand with a budget, again, it is done ahead of time. That's the entire purpose of a budget. And as such, it requires many predictions. One of those predictions is simply how many units do we think we're going to produce that next period, or what activity level are we going to be operating at? Now some companies that's the same year after year. It's pretty static. It doesn't change much. But in some cases, in many companies, it does. So we need to know the number of units expected. We need to know the revenue expected per unit, the selling price. We need to know all the various costs expected per unit, your direct materials, your direct labor, your variable overhead, and even we could bring in the variable selling and administrative costs. And then you also, very importantly, need to understand the fixed costs that do not directly relate to the number of units produced. So fixed costs as in manufacturing or fixed selling administrative. So to start our discussion, we're going to talk about a static budget, and then we'll move on to the comparison with a flexible budget. The idea of a static budget is that we're developing this based on one expected activity level. We assume we're going to operate at that activity level, and if we do, then hey, we can easily compare that budget to the actual results. So if this company always produces exactly 100,000 units per year or extremely close to that, they can build a static budget with all the various costs expected at that level. Again, the costs might change over time. So maybe they used more material than expected, or maybe they used less labor than expected, or the overhead. But it'll be comparable. We can actually compare it reasonably to our budget because we're at the same activity level. So the costs can change over time or throughout the year, but the activity level should not if we're using a static budget. So now the question is, what do we do if that activity level does change? We're no longer producing the 100,000 units we expected. We're producing maybe 120,000 units. And we'll see that in just a bit. But let's take a look at the budget, the static budget. Let's assume that every unit is sold for $30 per unit. So we'll have that down here multiplied by 100,000. That's our sales revenue. Let's assume every unit uses or is expected to use materials of $10 per unit. Every unit is expected to use direct labor of $7 per unit. We'll have variable overhead of $6 per unit. And the fixed overhead is just $15,000 regardless of how many units were produced. So that's why we have NA here. It doesn't matter how many units were produced within the relevant range. That's an important thing. At some point, if we all of a sudden jump up to 10 million units, then of course we're probably going to have to buy a new factory, get new equipment, all of that. But within our relevant range, within our current level of capacity, we don't need to worry about a rate per unit. We just plug in the $15,000. Now, for simplicity, we're just going to focus on the actual production costs and end at gross profit instead of bringing in selling, general, and administrative costs, although the same concept applies for selling and administrative costs. We'll just leave them out for now. So again, if we actually did produce and sell 100,000 units, then it would make perfect sense to compare the actual costs and revenues against what we budgeted for. Now what we have down here was our budget that we saw earlier, and here are the actual amounts for sales revenue, direct materials, labor, overhead, all of that. We can get a gross profit out of that. And hey, it looks like we did better. We had $975,000 of gross profit instead of $685,000. Now notice, for revenues, that's $300,000 better. More revenues better. That's where we get into this favorable or unfavorable discussion. Notice that every single one of these variances is a positive number. Of course, 0 is not really positive or negative, but there's no negative number here. We always use the absolute value of the difference between those two, and for that matter, it really doesn't matter which one you subtract first. It's always going to be a positive number anyways. To determine the sign, so to speak, we have to take a look at what that change means ultimately to gross profit. If it positively impacts gross profit, that's considered a favorable variance. If it negatively impacts gross profit, that's unfavorable. So for revenues, more is a good thing. That positively impacts gross profit. We had more revenues than we budgeted for, so that $300,000 is favorable. For direct materials, hey, we had more than we budgeted for, but that's a cost. So more cost is unfavorable, but notice it's still a positive number. Direct labor, we had more costs. That's unfavorable. Variable overhead, we had a little bit less cost than expected. So that's $22,500 favorable. Fixed overhead, because of its nature, you generally don't expect a whole lot of change there. Not saying there can't be any change. Maybe the rent cost a little bit more than expected or whatever. There could be changes, but in this case, for simplicity, we said it was the same. So to get the final number, of course, you can just compare the gross profits, and you see that, yeah, it's $290,000 better than expected, so that's favorable. But you could also net. You could just net your favorable and unfavorable variances together, and it'd end up with that same $290,000. So keep in mind, this was budgeted at 100,000 units, and we're just assuming that, hey, we actually produced 100,000 units. So these variances tell us something. It's easy to see that, hey, the sales department did better. For some reason, they were able to sell things, maybe at a higher price. They didn't sell more units in this example, so maybe they didn't have to give as many discounts or whatever. They got a higher price out of it. But some of the production managers, the direct materials and labor, they used a little more than expected. And then whoever's in charge of the variable overhead, we just had less than expected there. The question is, what happens if we actually sold 110,000 units? We budgeted for 100,000, but now we're selling 110,000 units. Now, I used the same numbers as our last exhibit, but now let's say we know it's 110,000 units. So at that higher level, we would certainly expect more revenue, more units sold, but we would also expect more costs. So you cannot say that just because we had more costs, that's a bad thing. We would expect more cost. The variance analysis needs to change, and this budget comparison right here no longer makes sense. Keeping this budget from 100,000 units, but comparing the dollar amounts to 110,000 units, we're going to get faulty results. We're saying here that, hey, you did a great job with your sales revenue. You have more than what we expected. Well, of course they have more than what they expected. They sold more units. But same with the materials and labor. If you got with the production manager and said, hey, what's the deal with the cost? Your cost is way out of line. The response from that production manager would say, of course it's higher than expected. We sold more units. They all take more materials and labor. So that's the problem with this faulty comparison using a static budget at the exact same level. So the answer to this is simply a flexible budget. Now, even though you think of this as a separate concept or calculation, in reality, It's the same idea as the static budget, only now we're redoing it based on 110,000 units. So now instead of taking 100,000 times 30, we take 110,000 units times 30. We get a new budgeted number. When we do that, we realize that, hey, your actual revenues came right in line with what we expected because we sold more units. So there's really no variance. And here's an interesting thing. For those costs, we initially said, hey, your costs were out of line. You spent way too much on materials and labor. They were unfavorable before. Now when we revise the budget, we realize, hey, we would have reasonably expected them to have 1.1 million of materials and 770,000 of direct labor, but guess what? They actually came in a little bit less than that. So now our discussion with that production manager would go differently. We'd say, good job managing your costs. You were less than what we expected at this higher level. Of course, fixed overhead may or may not have a change, but it would have nothing to do with the different activity level. So now the question is, what do we really need to prepare that flexible budget? Now, we need to understand the difference between variable and fixed costs. Fixed costs are not going to change, assuming we're still within our capacity, so we shouldn't revise that budgeted amount. Notice here, this budget under this 110,000 units is the exact same amount as it was before. We didn't flex that. We flexed all of the variable items, both revenues and costs. So we need to understand how variable costs behave compared to fixed costs, how they behave. Very importantly, if we do not already have the per unit sales and variable costs, we have to calculate it. Now in this case, they already gave us the rate per unit, but let's go back a second. Let's say they didn't. Let's say they just give us this budget at 100,000 units, and they just told us that, hey, our total budgeted cost is 3 million, or sales revenue is 3 million, and they gave us all these costs. If they didn't give us this middle column, we should be able to calculate it by taking 3 million divided by what we know as 100,000 units, and we'd back into these rates per unit. So one way or the other, either they give you those rates or you have to calculate them and plug them into this new variable. So here's how we would do that, and then those amounts are multiplied by the new number of units to flex the budget. Now there is an alternative way of doing that. Let's say you did not know the rate per unit. You could say if we went from 100,000 and we added 10,000 more, so to 110,000, we've increased it by 10%. You could simply do the exact same thing. You could increase each of these total amounts, each of these total variable amounts, by 10% by simply multiplying it by 1.1. And that would get you the same result here. That's another way to do it without the rate per unit. I prefer actually having the rate per unit. I like to know how much my units are costing per unit, how much they're generating. It's just nicer to see that number, but you can do it the other way. So that takes us to the end of this video on flexible budgets in general. But what I wanted to mention is there are multiple related videos out there that I have posted on related topics. So first of all, when we talk about flexible budgets, that assumes you've already discussed the standard costing idea. And standard costing simply means how much material, labor, revenue we had. Those are the standard costs. And then variance analysis, which actually takes standard costing and it takes this variance analysis into more depth, because now instead of just realizing, hey, we saved money on materials, variance analysis tells us whether we saved money on the materials because we paid less per pound or because we used fewer pounds, quantity. So that's an important concept that relates to this. There are also several master budget videos that we talk about the overall pieces of the budget: sales budget, production budget, materials, labor, and overhead budgets, all of those. And for each of these different topics, I have multiple practice exercises available on the YouTube channel. So feel free to check those out. Hopefully that helps out. Here, I just wanted to wrap up talking about some additional videos I have available. You can always browse my YouTube channel here. I know this is a link you won't be able to click, but you can type that in. You can search for it. You can search for Severson Accounting YouTube on Google. You'll be able to find that pretty quickly. And there's also a link to my Dropbox that has a spreadsheet of my entire collection of videos I have on YouTube. Just one other way to find it. This should be available in the profile of the YouTube video. But if all else fails, feel free to comment on this video and I'll respond with this link to directly get you there. So I thank you for your time. I hope this has helped to clarify some of these topics. Have a great day.